Hello, my name is Evan, and welcome to Economics 101, your number one source for everything economics. So, what's going on with the current housing market as we approach the summer? And the simple answer is just about the same that it's been for the last couple of years. Okay? The housing market is still in somewhat of a freeze, and of course that's regional, meaning you could be experiencing something completely different in your neck of the woods. So in today's video, we're going to break down the overall view of the current housing market as it stands April 2026. Okay? Basically, right now, your homes are still sitting longer than average. Your buyers continue to slow down. Mortgage payments have exploded, and millions of Americans are asking the same question. Is the housing crash finally here, or is it coming? Because right now, the market feels completely broken. People could afford homes just a few years ago, suddenly can't. Mortgage rates remain painfully high, and even though demand is slowing or has slowed, prices in many areas still haven't fallen enough to restore affordability. So what's actually happening? Today we're going to break it down, why the housing market continues to slow down, how the Federal Reserve changed everything, and what buyers, homeowners, and investors could expect next. Before we jump into the video, I do have a quick favor that really helps grow the channel. If you enjoy simple explanations about the economy, real estate, financial markets, hit the like button and subscribe to Economics 101, your number one source for everything econ. All right, let's hop into it. So, affordability crisis. The biggest problem in the housing right now is affordability, and it has been. And honestly, this is one of the worst affordability environments in decades. All right? Why? Because home prices surged massively after 2020. At the same time, mortgage rates exploded higher. Inflation pushed up living costs. You had your insurance premiums, which increased. Property taxes rose in a lot of areas, and so buyers they got squeezed in a lot of different directions. And so to simplify this, to put it in perspective, so a few years ago, someone buying a $400,000 home with low mortgage rates might have had a manageable monthly payment, but today the same house with today's rates could cost hundreds, sometimes thousands per month. That changes everything, okay? Most people don't actually look at the cost of something. They look at the payments on how much they have to pay per month, okay? So people don't buy homes based on just the price. They buy based on those monthly payments, and those payments have become brutal. That's why many first-time buyers are getting locked out of the market entirely. Now let's talk about the biggest driver behind this slowdown, the Federal Reserve. During the inflation fight, the Fed aggressively raised interest rates. The goal was simple: slow the economy down enough to bring inflation under control, and housing was one of the first industries hit. Why is this? Because housing depends heavily on borrowing. When interest rates rise, mortgage rates rise, monthly payments rise, okay? In turn, demand falls. All right? So when you have that demand that falls, your home sales, those home sales begin to slow down. That's exactly what happened. Mortgage rates climbed to levels we hadn't seen in years, and suddenly buyers had much less purchasing power. Okay? Some people lost hundreds of thousands of dollars in buying power almost overnight. That's why the housing market cooled so quickly. The Fed essentially slammed the brakes on real estate demand. Okay? Understand the Fed uses, in its tool belt, interest rates are the most used tool. So when interest rates go up, that's basically slamming the brakes on real estate demand. Okay? So an inventory problem. Now here's where things get a little weird. Normally when demand falls, home prices fall sharply too, but housing inventory remains unusually tight. And this is because millions of homeowners are locked into ultra low mortgage rates during 2020 and 2021. Some people refinance below 3%. And think about that. Like, if you own a home with a 2.8% mortgage, why would you sell and buy another home at a 7%? For many people, it makes no financial sense. So homeowners are staying put. They're staying where they're at. Economists call this the lock-in effect. And I talked about the lock-in effect on previous videos. And it's just, the lock-in effect is creating a strange market where buyers are struggling, sales volumes is falling, but inventory still isn't flooding the market. That's one reason national home prices haven't collapsed the way some people expected. Supply remains constrained in a sense, okay? So talking about regional housing markets for a second, okay? This is also important. There's no single U.S. housing market. There is no single U.S. housing market. Different regions are behaving very differently, okay? Some pandemic boom cities are seeing your price cuts, your slower demand. In some of your cities that were booming during the pandemic, you're seeing rising inventory now. So especially markets that experienced massive price surges during the remote work migration, right? Meanwhile, some areas with limited housing supply are staying relatively resilient. That's why housing headlines can feel a little confusing at times, because one city may be cooling aggressively while another remains competitive. And it might not be, it might be just areas within your city. It might not even be the city next to you. It just might be areas within that local city where a part is aggressively cooling while another area is booming. So local factors matter. Population growth matters. Employment, wage trends, construction activity. All of these things play a part. Your insurance costs, your things like your property taxes, all of these things combined, they influence our housing demand. Okay, and investors are watching these things. They're watching regional weakness very carefully right now. Okay, let's take a shift and talk a little bit about builders, investors, and consumer behavior. Okay, home builders are in a difficult position right now. Higher interest rates increased construction financing costs. Say that again. Higher interest rates increase construction financing costs. Materials remain expensive. Labor shortages continue in some areas. At the same time, affordability issues are reducing buyer demand. So builders responded by offering mortgage rate buy downs. Some builders you may see have cut prices, providing different type of buyer incentives, things like that, because they need buyers moving into these homes, right? They don't want these homes just sitting. Meanwhile, investors are becoming more cautious too. During the low interest rate era, real estate investing exploded. Cheap borrowing fueled speculation, right? But now money is expensive again compared to where it was, compared to where those interest rates were. They're higher. That makes the cost of borrowing, that makes money more expensive. Okay, so that changes investors' behavior dramatically, and consumers themselves are becoming more cautious overall. People are increasingly worried about things like of course, debt. Everybody's talking about employment, so everybody's kind of focused or concerned about layoffs. Inflation is still an issue. Economic uncertainty. Housing confidence weakens when economic confidence weakens, and housing markets are extremely psychological. All right, quick pause, guys. If you want more breakdowns like this that explains what's happening in our economy without the confusing financial jargon, make sure you subscribe and turn your notifications on. In these videos, in my videos, I cover housing, inflation, the Fed, jobs, the stock market, all simplified so anyone can understand it. All right, so let's hop back into it and keep it going. So housing market matters because it affects almost everything else. When when housing slows down, construction slows down, furniture sales slow, appliance sales, they slow down, lending slows down. So you can kind of see how all of it's related. Consumer confidence, that's a part of it. It weakens. Housing creates a huge ripple effect across the economy. It's a leading indicator on actually how well our economy is doing overall. Okay, and that's why economists watch it so closely. Historically, housing weakness can sometimes signal a broader economic slowdown. Now, this doesn't automatically mean a housing crash or a recession is guaranteed, but if elevated rates combined with slowing demand absolutely increases the risk, especially if you are starting to see consumer spending start to weaken. You're starting to see things like unemployment start to rise, or credit conditions tightening it further. So the economy is deeply connected. It's more deeply connected than a lot of people would like to think about or like to consider. And housing sits right in the middle of everything. So typically, if there's an effect to the housing market, we're going to start seeing ripple effects throughout our economy. All right. So what happens next? Where does the housing market go from here? There are a few major possibilities. Just break it down scenarios. Scenario number one, mortgage rates gradually fall, improving affordability and stabilizing demand. Scenario number two, rates stay elevated longer, causing further slowdown and additional price pressure. Scenario number three, a recession hits, weakens unemployment, and creating a broader housing market stress. All right. But right now, the biggest factor remains the Federal Reserve. If inflation stays stubborn, rates could remain higher longer. If inflation cools significantly, markets may expect future rate cuts, and that could eventually bring mortgage rates down. But even then, housing affordability may take years to fully normalize, because income haven't kept pace with home prices in many parts of the country. So, is the housing market crashing? No, not exactly. But it is slowing significantly under the pressure of higher mortgage rates, weak affordability, tight inventory, and economic uncertainty. All right. In my opinion, I do not expect a housing market crash. But until borrowing costs fall significantly, many Americans may remain stuck on the sidelines, just waiting for the opportunity to kind of jump in. So now I want to hear from you. Do you think home prices will fall in 2026? Drop your thoughts in the comments below. And if you enjoyed this video, make sure to like, subscribe, and share with someone who is trying to understand the housing market a little bit better. I'm going to do a lot more videos on the housing market. But for now, this is Economics 101, where we make economics make sense. Thank you for tuning in.